Good morning and welcome to Charting the Markets on Friday, the 17th of February. Earlier today, we had UK retail sales out, which came in much better than expected at 0.5% in January month on month. And that is compared to a forecast of minus 0.3%, so much better than expected. And also when compared to the December number, which was upwardly revised to minus 1.2%. Now, non-store retailing, that is to say mainly online retailers, sales volumes rose by 2%, and also sales at non-food stores increased by 0.6%, helped by online sale promotions. Now, sales of automotive fuels were also up 1.7%, as fuel prices in the UK continued to fall. And however, sales at food stores fell by 0.5% as the cost of living crisis still lingers on. Now, the general trend with regards to retail sales is still down, and we remain 1.4% below their pre-coronavirus February 2020 levels. Now, even though those numbers were quite good, if you look at the FTSE 100 daily chart, what we can see here is actually a fall through yesterday's lows at 7,978 on this daily financial bet after the FTSE 100 made a new all-time record high yesterday. And this came on the back of more hawkish news out of the US and also stronger producer price index data as well as employment data. But I'll come back to that later on. And from a technical perspective, first of all, what I would like to mention is that the FTSE 100 is still showing this negative triple divergence going back to the mid-January high. And what that actually means is that even though we've made higher highs in the course of February on the price chart, taking the FTSE 100 to all-time highs, if you look at the lower chart here, the relative strength index, the RSI, we have a series of lower highs, and this is called negative divergence. And when you combine this with this upward sloping wedge formation here, it gives you a strong indication that the risk is increasing for a potential reversal to the downside to be seen. Now, for this to take place, what we need to see is actually a daily close above the uptrend line, the January to February uptrend line, that is, which currently can be seen at 7,936. If we were to fall through there and the last reaction low, which was the low made on Wednesday at 7,221, then a minor top at least will have been formed, in which case we could be sliding back to the longer term November to February uptrend line, which currently comes in around 7,814, just above the late January highs. So interesting times ahead with regards to the FTSE 100, because perhaps we might short term be topping out here if we were to see further weakness in this index later today. Now, the German DAX futures contract also looks quite similar in that we've also seen here over the last few days this negative divergence on the relative strength index and the index falling through yesterday's low and also through its uptrend line. And you can see here we had an uptrend line. If I actually go back to the beginning of the year, you can see we had an uptrend line here, the thinner line, which was fallen through on the 10th of February, and since then has acted as resistance. Quite often this happens when a trend line gets breached. Going forward, it will then act as the opposite. So in this case, it was an uptrend line support, because of inverse polarity, has become resistance. And as you can see here, the last 3 days, we were capped by that upward sloping line, and now we have to redraw our uptrend line and are currently in the process of falling through that here. And if we were to see further weakness in the days ahead, then we could retest the mid-February lows between 15,272 and 245, and a slip and daily close below 15,245 would put the January lows, that key support area here, back into place. And this comes in between 14,992 and 14,904. So these are the areas which are really important for the medium-term uptrend, because if they were to be slipped through, we would have formed a major top. But right now, all we're seeing is a break through the trend line, So short-term weakness, and we have to see whether going forward investors will once again buy these dips as they have done in the past few weeks, or whether this time around we could actually see a reversal take us much lower. So that'll be quite interesting to see in the days ahead. Now, this morning we had German producer price inflation actually coming in at a 16-month low, and the inflation in Germany with regards to producer prices dropped to 17.8% in January versus 21.6% in December. So a 16-month low having been seen there, and so the economy actually is still being all right with regards to Germany, as inflation, at least producer price inflation, is continuing to come down. But the DAX was pushed lower on the back of lower Asian and mainly American markets. And what has happened there yesterday is kind of interesting, because you had producer price inflation increasing by 0.7% month on month in January, and that's the most in 7 months, and by significantly more than the forecast 0.4% rise we were expecting. And this really reinforces the hawkish stance by the US Federal Reserve, because basically it still intends to hike interest rates in March. We also had the presidents of the St. Louis Fed out, James Bullard, and also the president of the Cleveland Fed, Loretta Mester, both saying that they would probably go for a 50 basis point rate hike in the March meeting. So if that is the case, the anticipation we had previously of another 25 basis point rate hike in the US Fed funds rate, now moving more towards the 50 basis point rate hike, that could really dampen the uptrend with regards to equity markets, not just in the US, but also globally. So this is what has taken the US markets lower yesterday. So stronger producer price inflation. Also, on a weekly basis, the unemployment data actually coming in much better than expected. So unemployment falling, which all points to a stronger US economy, and therefore the odds of the Fed still being very hawkish going forward. And here what we've seen on the Nasdaq 100 is basically a bearish engulfing pattern, bearish engulfing candle here, basically taking out the previous 2 days positive data, and meaning that we once again topped out, and this time at 12,747 on the Nasdaq 100, and have also fallen through and closed below the January to February uptrend line. So this is actually short-term quite negative, and means that the odds are stacked in favor of the bears short-term, and the 10th of February low at 12,203 possibly being retested. And failure there would actually have more bearish implications, because it could take us back down again towards the mid-November high at 12,084. And also the red line here, you can see the 200-day simple moving average at 11,894. So these are downside targets in case of 12,203 being fallen through with regards to the Nasdaq 100. The hawkish stance by the US Fed, and also the recent comments by Fed committee members, have led to a 6-week rise in the price of the US dollar, alongside better than expected employment data in the US, and also inflation data. And if you look at the dollar basket, what is interesting from a technical perspective is that we have now actually broken through this key resistance area I've been mentioning for the past few weeks, between 103.08 and 103.66. That is to say, the early December lows and also the early February high. And we have now, for the first time yesterday, closed above that key resistance area, meaning that a bullish reversal is currently taking place, and also pointing towards the mid-December high at 104.56 being targeted short term, and then above there, the highs seen in early December and also early January between 105.37 and 105.49. If those highs were to be taken out, we would be forming a medium-term bullish reversal in the dollar basket, and we would most likely head back up again towards the red line here, the 200-day simply moving average at 106.20, and probably go much further. So we could see a major reversal in the US dollar trend in the days and weeks ahead, now that we've seen at least a minor bottom being formed here. And basically, as long as we stay above this week's low at 102.18 on this dollar basket index, then the uptrend really remains intact, and we should see higher levels for the US dollar going forward. Now, with regards to the inverse of that, as we know, 57.6% of the US dollar basket is made up of the euro. What we can see here is we tested earlier this week on Tuesday this key support area, which is now, because of inverse polarity, become a resistance area, and managed to rise to 108.04, but then have come off again. And you can see here we are now heading for a third consecutive third-day lower. And we are heading towards the 5th of December high at 105.95, and below there, the key support area really to look out for is between 104.84 and 104.44. That is to say, made up of the mid-November low and also the early January low. Sorry, the mid-November high and the early January low. So that's the area we are targeting at the moment, as long as we stay below 108.04 on a daily closing basis. That is to say, the last reaction high we saw earlier this week on Tuesday. See here is that euro sterling has, after 7 consecutive days of falling prices, bounced off a short-term support line. Actually, to be correct, we need to redraw that line and going back to the December lows. And this we did at 88.04, and since then have seen 3 consecutive days of higher euro levels versus the British pound. And this was on the back of comments by Christine Lagarde pointing towards another 50 basis point rate hike with regards to the European Central Bank. And here we can see we have now risen above the 89 area, and we are heading back up again towards 89.78. That is to say, the early February high. And as we can see here from a medium perspective, we are still in a medium-term uptrend, because we have a series of higher highs and a series of higher lows. So as long as we stay above 88.04, the uptrend medium term remains intact for euro sterling. Commodity markets have also been affected by the stronger dollar, with the gold price coming off very sharply over the last few days and weeks. And before I look at gold, I'd like to very quickly have a look at the price of Brent crude oil, because here we've also started to come off again, having risen previously in the last week to a 1.5 week high at $83.73. We have now started to come off again. And basically, we've been trading in a sideways range since mid-November, where the price of Brent crude oil has always been capped by the $89-ish region and has been supported around the $76 to $75 region. But this time around, we are once more heading back down again towards the December to February uptrend line around the $80 mark. And below there, we also have the current February low at $79.04, a fall through which would take the January low at 75.65 back into the picture, along with the December low at $75.32. So further downside likely to be seen with regards to the price of Brent crude oil. But as I mentioned just now, the price of gold is also falling further and is now testing some minor support here. And this is on the back of a 6-week high being seen in the US dollar because of more hawkish rhetoric coming out of the US Federal Reserve, and because of strong data coming out of the US. Producer price inflation data yesterday coming in at 0.7% month on month, which is a 7-month high, basically, and was much higher than the 0.4%, which was predicted by the financial markets. So here we can see we are currently testing this minor support zone made up of the early and mid-December highs between $1,825 and $1,810 per troy ounce. So that's minor support here. But if that were to give way, we would then be heading down again towards the red line here, which is the 200-day simple moving average at $1,776 per troy ounce. Just above that, we have the mid-November high at $1,787, which is also a downside target. Now, for the bulls to be back in control with regards to gold, what we really need to see is a rise above the last reaction high. That is to say, a high which is higher than the candle to its left and the one to its right. And this can be seen on this doji pattern here, which was made on Tuesday. And the high here is $1,871. So as long as we stay below $1,871, the downtrend we're seeing in regards to gold is likely to continue in the days ahead. I'd like to finish up on the copper chart. And copper is interesting because, yes, it is also coming off on the back of that stronger US dollar, but it does so after having tried to retest its early February highs at $9,064 per ton. And we have been basically range trading for the last 2 weeks with regards to the copper price. And we have to see whether we will, going forward with the lower copper price that we're seeing at the moment, fall through this week's low at 8,787, and also the uptrend line, which goes back to October of last year at 8,760. Because if we were to fall through those levels, both that low and the uptrend line, then we would most likely retest the November and December highs between 8,629 and 8,593, and most likely fall further towards the 200-day simple moving average at 8,312. So possibly further downside being in store for the price of copper as well as other precious metals, as we saw, like gold, as long as we stay below the 8th of February high at $9,064. Thank you very much for watching Charting the Markets with me today. Please feel free to follow me on Twitter. My Twitter handle is @AxelR_IG.